Understanding the 10-10-10 investing framework. Investing can often feel overwhelming. With thousands of stocks, mutual funds, exchange-traded funds, and other financial instruments available, investors frequently struggle to determine the best course of action. Emotions such as fear, greed, and uncertainty can influence investment decisions, leading to costly mistakes. One simple yet powerful strategy designed to help investors make better financial choices is the 10-10-10 rule. The 10-10-10 rule is a decision-making framework that encourages investors to evaluate the potential consequences of an investment decision over 3 different time horizons: 10 minutes, 10 months, and 10 years. Rather than focusing solely on immediate gains or losses, this approach promotes a broader perspective that aligns investment decisions with long-term financial goals. Understanding how the 10-10-10 rule works can help investors reduce emotional decision-making, avoid impulsive actions, and build greater confidence in their financial strategies. Whether you are a beginner investor or someone with years of market experience, this rule can provide valuable guidance during periods of market uncertainty. The 10-10-10 rule was originally developed as a decision-making framework that could be applied to various aspects of life. In investing, the concept has become particularly valuable because financial decisions often involve balancing short-term emotions with long-term objectives. The rule asks 3 simple questions before making an investment decision. How will I feel about this decision in 10 minutes? How will I feel about this decision in 10 months? How will I feel about this decision in 10 years? By considering these different time frames, investors gain a clearer understanding of both the immediate and long-term consequences of their choices. This structured approach encourages thoughtful analysis instead of emotional reactions. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentease.com and use code BLOG to receive 20% off your next purchase. One of the biggest challenges in investing is resisting the temptation to react to short-term market movements. Financial markets experience daily fluctuations, and these changes can trigger anxiety or excitement among investors. When stock prices fall sharply, investors often feel pressured to sell in order to avoid further losses. Conversely, when markets rise rapidly, investors may rush to buy assets out of fear of missing out. Both reactions are driven by emotion rather than careful analysis. The 10-10-10 rule helps investors step back and evaluate whether a decision that feels right today will still make sense months or years later. This perspective is essential because wealth creation typically occurs over long periods rather than through short-term speculation. The first time frame: thinking 10 minutes ahead. The first part of the rule focuses on immediate emotions and reactions. Investors should consider how they will feel in the next 10 minutes after making a particular investment decision. Suppose an investor is considering selling a stock because the market has dropped significantly. Selling may provide immediate relief from anxiety. The investor might feel better knowing they have avoided additional losses. However, focusing only on this short-term emotional benefit can be dangerous. Many investors make decisions based solely on immediate feelings without considering future consequences. The 10-minute perspective helps investors identify emotional triggers. It reveals whether a decision is motivated by fear, greed, panic, or excitement rather than rational analysis. The second time frame: looking 10 months into the future. The next step involves evaluating the decision over a medium-term period of approximately 10 months. At this stage, investors should consider how market conditions may evolve and whether the decision aligns with their financial objectives. For example, selling a quality stock during a temporary market correction may feel good today, but in 10 months the stock could recover and generate significant gains. Similarly, purchasing a highly speculative investment because it is trending on social media may provide excitement in the short term. However, 10 months later, the investment could perform poorly if it lacks strong fundamentals. This time horizon encourages investors to think beyond temporary market noise and assess whether their decision remains sensible over a longer period. The third time frame, evaluating the impact over 10 years. The final and most important aspect of the rule is considering the long-term impact of the decision. 10 years is a substantial period in the world of investing. During this time, markets typically experience multiple cycles, including bull markets, bear markets, recessions, and recoveries. When investors evaluate decisions from a 10-year perspective, they focus on wealth creation rather than short-term price movements. They begin asking more meaningful questions such as, will this investment help me achieve financial independence? Will this decision support my retirement goals? Will this asset still have value and growth potential a decade from now? By emphasizing long-term outcomes, the 10-10-10 rule promotes disciplined investing and reduces the likelihood of making impulsive choices that could undermine future financial success. Emotions are among the greatest enemies of successful investing. Fear can cause investors to sell assets during market downturns, while greed can encourage excessive risk-taking during market rallies. The 10-10-10 rule creates a pause between emotional reactions and financial decisions. Instead of acting immediately, investors are encouraged to evaluate consequences across multiple time horizons. This process introduces logic and reflection into the decision-making process. As a result, investors become less likely to make choices they later regret. Over time, consistently applying this framework can help build emotional discipline, which is one of the most valuable traits any investor can develop. 10-10-10 rule example. Imagine an investor who owns shares in a well-established company. A negative news event causes the stock price to fall by 15% in a single day. The investor feels anxious and considers selling. Using the 10-10-10 rule, they ask themselves how selling would make them feel in 10 minutes. The answer may be relief because they no longer have to worry about further losses. Next, they consider how they might feel in 10 months. If the company remains fundamentally strong, the stock may recover, and they could regret selling at a low price. Finally, they evaluate the decision from a 10-year perspective. If the company has strong growth potential and a history of long-term success, holding the investment may be the better choice. By analyzing the situation through these three lenses, the investor can make a more informed decision rather than reacting emotionally. The 10-10-10 is not limited to selling decisions. It can also help investors evaluate potential purchases. Suppose an investor wants to buy shares in a company that has recently gained significant attention online. Excitement and optimism may create pressure to invest immediately. The investor can ask how they will feel in 10 minutes after buying. They may feel enthusiastic and confident. Then they should consider how they might feel in 10 months if the stock experiences volatility or fails to meet expectations. Finally, they should assess whether the company has strong long-term prospects that could justify holding the investment for 10 years. This process encourages thoughtful analysis and reduces the risk of chasing short-term trends. One of the biggest advantages of the 10-10-10 rule is its simplicity. Investors do not need advanced financial knowledge or complex analytical tools to apply it. The framework also encourages long-term thinking, which is often associated with better investment outcomes. By focusing on future consequences, investors become more patient and less reactive. Another benefit is improved decision quality. Considering multiple time horizons helps investors identify potential risks and rewards that may not be obvious when focusing solely on the present. The rule also promotes consistency. Investors who regularly use this approach develop a structured decision-making process that can be applied across various market conditions. Although the 10-10-10 rule is a valuable tool, it should not replace thorough investment research. Investors still need to evaluate factors such as company fundamentals, valuation, competitive advantages, industry trends, and overall market conditions. The rule is best viewed as a complement to traditional investment analysis rather than a substitute for it. Additionally, no decision-making framework can eliminate uncertainty. Markets are inherently unpredictable, and even well-reasoned decisions may not always produce the desired outcomes. However, using the 10-10-10 rule can significantly improve the quality of decision-making and help investors remain focused on their long-term goals. The most effective way to use the 10-10-10 rule is to make it a regular part of your investment process. Before buying, selling, or making significant portfolio changes, take a few moments to evaluate the decision through each of the 3 time horizons. Keep a written record of your answers. Reviewing past decisions can provide valuable insights into your thinking patterns and help you improve future investment choices. Over time, this habit can strengthen discipline, reduce emotional reactions, and increase confidence in your financial decisions. Conclusion: the 10-10-10 rule in investing is a simple yet highly effective framework for making smarter financial decisions. By evaluating how a decision will impact you in 10 minutes, 10 months, and 10 years, you gain a broader perspective that balances immediate emotions with long-term objectives. This approach helps investors avoid impulsive reactions, stay focused on their goals, and make more rational choices during both market highs and lows. While the rule should not replace fundamental research and analysis, it serves as a powerful tool for improving investment discipline and fostering a long-term mindset. In a world where market noise and emotional pressures often dominate financial decision-making, the 10-10-10 rule offers a practical roadmap for building lasting wealth and achieving greater investing success. Thank you for watching.